How will Donald Trump's presidency impact the U.S. housing market? I've conducted thorough research into Trump's potential policies, examining comparable periods in U.S. history to understand how they might impact homebuyers, sellers, and investors in 2025. The news might shock you, and we start with the first key factor, interest rates. Right now, as I write this, the average 30-year mortgage rate in the US is 6.92%. If we take a look at the chart, you can see that since late September, the rate has actually shot up by about 0.79%, which is slightly confusing given the situation in the Federal Reserve. You see, in mid-September, Jerome Powell and the Federal Reserve lowered the federal funds rate from 5% to 4.5%. This move is designed, in theory, to bring down interest rates across the board, including mortgage rates. I won't delve too deeply into the mechanics here, but essentially when the Fed cuts rates, it typically pulls down Treasury rates as well, which are a major factor in determining 30-year mortgage rates. However, despite this rate cut, mortgage rates actually rose. And even after another cut on November 7th, mortgage rates seem to completely ignore the Fed's efforts. So what is going on? It is true that there are several factors at play here, but an interesting pattern stood out in the past few weeks. Trump's odds of winning the election seem to be moving in sync with the 10-year Treasury yield, a key factor in determining mortgage rates. You can see from Jim Bianco's chart that the 10-year yield, which remember is the key factor in determining mortgage rates, track Trump's chances of winning right up until November 1st. What's happening in the bond market appears to be disagreeing with the Fed's recent rate cuts, likely due to the election. Investors think Trump's proposed policies might lead to higher inflation, so they're reacting early by pushing rates higher, almost reaching new peaks. Now, this makes no sense to a lot of you. Why would Trump, the same person who pressured the Fed to lower rates in the past, be the one whose presidency could lead to higher borrowing costs and possibly reduced homebuyer demand? After all, he's the pro-business, low-tax candidate who's built his real estate empire largely on debt. He's even said he's the king of debt. So what is going on here? He surely wouldn't want this. He doesn't want high rates. Well, to understand, we can get a helpful clue if we look at the Committee for a Responsible Federal Budget. They have actually done an analysis looking at the fiscal impact for both the Harris administration and the Trump administration. Remember, this is a supposedly nonpartisan group that analyzes U.S. budget policies and advocates for reducing national debt to promote long-term economic stability, and their studies find that the Trump administration is estimated to raise the U.S. debt to $7.75 trillion by the end of 2035. Then on top of this, you have the tariff situation. Trump is obviously a big fan of tariffs. His plan calls for a blanket tariff of 10 to 20% on all imports, with an additional tariff of 60 to 100% on goods brought in from China. The bond market expects these policies to drive up inflation, meaning they anticipate higher prices for goods across the board. So essentially, the bond market is telling us they think inflation will be high during the next 4 years, and this could in turn lead to higher mortgage rates and therefore lower homebuyer demand and lower prices. But of course, this is no guarantee. Remember, this isn't a direct result of Trump's actions, it's simply the bond market reacting to his proposed policies, a downstream effect. But on the other side of the coin, Trump is the pro-business candidate who can and probably will inspire confidence throughout the markets, including the housing market. The problem is that 2024 is very different from 2016. Just look at it from the housing situation really quick. In November 2024, the typical payment for a buyer entering the market was $2,600 a month, which is just slightly below the all-time high. In 2016, when he came into office the first time, this same figure, according to Zillow data, was closer to $950 a month, which represents a 205% increase, nearly tripling this figure. The housing market was a different world back then. So what is going to happen? Well, in my opinion, I don't think this move from the bond market will last long term. At the end of the day, Trump is a low-interest president. He does not like it when the Fed raise or level the rate. He wants low rates. In fact, during his last term, he tweeted about the Fed 100 times. In 2019, he called for more aggressive cuts. And remember, this was before COVID and the rate was only 2.4% back then. And even when the Fed lowered the rate multiple times that year, he went even further, claiming we should push the rate into negative territory. And once again, I remind you that this was during a time when we had relatively low rates. I would assume that given inflation stays somewhat situated, he's going to keep firing off tweets like this. In my view, lower mortgage rates should boost demand for homes, but here's the issue. This approach doesn't actually solve the root problem. Whichever way Trump goes, the housing market is sort of stuck between expensive and even more expensive. When it comes to housing affordability, simply lowering rates won't make homes more affordable in the long term. It could actually make things worse. Lower rates push up demand, but without adding more homes to the market, prices remain high and supply stays tight. As Redfin CEO Glenn Kelman explains, the real driver of high prices and low affordability is the lack of available homes. You can hear him explain this double-edged sword in this clip.
So in light of that, Glenn, what is it going to take to see more meaningful levels of inventory hit the market? I mean, rates coming down is certainly one piece of the puzzle, but what else needs to kick into gear here?
That's the right question. And on that front, I don't expect to see much progress. We're talking to many people who are rate locked. They got a mortgage at 3% or 3.5% a few years ago, and they still can't afford to buy their own home. 2.5% of American homes changed hands in the past 12 months, which is a 30-year low. So on the inventory side, we are still going to be crimped, and that is going to be the gating factor for home sales in 2025. Maybe we'll go up to 4.5 million from a low of 3.9 million this year, but it isn't going to be 5 million or 6 million because there just aren't enough people who want to sell their home.
Glenn Kelman just explained that inventory is the core issue in the housing market. Without a clear plan to build more homes, Trump's push for lower interest rates, tax cuts, and economic growth could have the opposite effect on housing affordability. The reality is that returning to 2016 affordability levels likely is impossible without a market correction or crash. Here's why. Affordability is essentially the balance between what people earn and how much they need to spend on a typical home. Improving this would require either exceptionally high wage growth outpacing home prices while rates drop, or an economic downturn that brings prices down overall. Homes were so affordable in 2016 because the market was still recovering from the 2007 crash, which left prices lower and rates near zero. Without a similar economic event or a large-scale government-backed plan to flood the market with new homes, significant improvements in affordability are unlikely. We either crash, which is in theory unlikely given Trump's pro-business, economy above all else approach, or affordability remains strained as inventory remains strained. The unfortunate truth is that you can't have it all. A thriving economy, low rates, no inflation, and affordable homes is a dynamic that's nearly impossible to achieve because it goes against the very principles governing housing economics. With Trump sure to push rates down and the economy relatively solid, it's very hard for home prices and affordability to get any better. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know in the comments below where you think home prices will go over the next 4 years.